everyone, and in this video we are going to start with chapter 4, which is covering employee net pay and pay methods. In this video we are going to cover learning objectives 4.1 through 4.3. So in chapter 4 we start identifying the deductions that are coming off an employee's payroll check. Now the first thing to keep in mind, as covered in chapter 2, is your gross pay. This is the amount of the employee's pay prior to any mandatory and voluntary deductions. Remember, the gross pay is calculated by taking the number of hours that they work, multiplied by their regular wage, which equals the gross pay. Now, once the employer calculates the gross pay, there are some pre-tax deductions that can take place that reduce the amount of the employee's taxable income. Some of the voluntary deductions that can take place is insurance, which is health insurance. Some companies have a cafeteria plan, supplemental and disability insurance, short-term disability insurance, and long-term disability insurance. And this is covered on page 114 and 115 in your book. Some other pre-tax voluntary deductions is retirement. Some of the different retirement plans that an employer can offer to their employees is 401k, 403b, a simple 401k, an IRA, ESOP, and any profit sharing plans. Now, kind of a new term to some students might be a pre-tax voluntary deductions, which is called a cafeteria plan. This is known as Section 125, and this is covered on page 115 and 116 in your book. All right, so the IRS has qualified plans that are not subject to the federal income tax or FICA taxes. Some of the cafeteria plans are flexible spending accounts, which flexible spending accounts, you can have money taken off your checks pre-tax to help pay for medical expenses, child care expenses, and prescription costs. One thing to keep in mind is that you do have to have receipts in order to justify the amounts that you want to take out of your flexible spending accounts, because you must use that money up within a 1-year period. The other pre-tax cafeteria plan is called a health savings account, which is HSA, and this may be used to help pay for long-term care. So these are some of the pre-tax voluntary deductions. Now, an example of how this would be calculated, which is covered on page 117 in your book. Daniel has gross wages of $1,125. He has decided to have 401k taken out of $100. He has health insurance taken out at $113.80. So in order to calculate Daniel's taxable income,